What if I told you the dollar's collapse isn't a matter of if, but when? That there's a mathematical sequence, a seven-stage pattern that has destroyed every global reserve currency in history, and that the US dollar is currently in stage 5? Not stage 2, not stage 3, stage 5 of 7. This isn't speculation. This is historical precedent. For reserve currencies across 6 centuries, the Portuguese real, the Dutch guilder, the British pound sterling, the French franc, each dominated global trade. Each believed they were exceptional. Each followed the exact same pattern. And each collapsed. The dollar became the world's reserve currency in 1944, 81 years ago. And if you understand the pattern, if you know what to look for, you can see exactly where this ends. The sequence is already in motion. The stages are unfolding. And the only question is whether you repaying attention or whether you'll be blindsided when stage 7 arrives. Let me show you the pattern. Let me show you the 7 stages. And let me show you the evidence that we are further along than anyone wants to admit. Before we map the stages, you need to understand what makes a reserve currency different from just a strong currency. A reserve currency isn't simply valuable. It's structurally necessary to the global system. When your currency is the reserve currency, other nations must hold it in their central bank vaults. Not want to. Must. Because international trade is denominated in your currency. Because commodities, oil, copper, wheat, are priced in your currency. Because to participate in global commerce, every country needs a stockpile of your money. This creates what the French finance minister Valéry Giscard d'Estaing called exorbitant privilege in 1965. You can print currency and exchange it for real goods produced by other nations. You can run perpetual trade deficits because foreign countries need to accumulate your currency for reserves. You can borrow at artificially low interest rates because demand for your bonds isn't discretionary, it's structural. The global system needs them. Being the reserve currency is the ultimate economic weapon. It's why empires fight wars to achieve it. And it's why they fragment when they lose it. Now here are the 7 stages. And as I walk through them, I want you to watch for something specific. Watch how each stage creates the conditions for the next. Watch how success in one stage plants the seeds of failure in the following stage. This isn't random. It's a cycle, a trap that reserve currencies cannot escape. Stage 1. Military dominance and trade route control. Every reserve currency begins with overwhelming military power that controls the physical infrastructure of global trade. Not just having a strong military, controlling the pathways through which commerce flows. Portugal achieved this in the 1450s. They mastered oceanic navigation while other European powers were still hugging coastlines. In 1488, Bartolome Dias rounded the Cape of Good Hope, opening a sea route to Asia that bypassed Ottoman-controlled land routes. Portugal militarized this advantage immediately. Portuguese warships dominated the Indian Ocean, the South China Sea, the Atlantic. They established fortified trading posts at every strategic choke point. Goa, Malacca, Macau, Mozambique, Hormuz. These weren't just ports. They were armed fortresses. Portuguese cannons controlled who could trade and on what terms. Want spices from the Moluccas? You deal with Portugal. Want to trade silk from China? You need Portuguese permission. They charged fees, imposed tariffs, seized ships that bypassed their system. This military control of trade routes made the Portuguese real the currency that mattered. Merchants across 3 continents needed reals to conduct business in Portuguese-controlled waters. The real became the reserve currency not because it was backed by gold, because it was backed by cannons. The Dutch followed the same pattern. The Dutch East India Company, the VOC, wasn't a trading company. It was a military power with its own army and navy. 40 warships, 20,000 soldiers. They conquered Portuguese trading posts, seized the Spice Islands, established Amsterdam as the center of global finance. Dutch ships dominated the Baltic, the Atlantic, the Indian Ocean. The guilder became necessary because Dutch military power made it impossible to trade without it. Britain perfected the model. At its peak in the 1800s, the Royal Navy had more warships than the next 5 nations combined. Britannia rules the waves wasn't poetry. It was operational fact. Britain controlled the Suez Canal, Gibraltar, Singapore, the Straits of Malacca. Every critical choke point. The pound sterling became the global currency because British naval power made international trade impossible without it. The United States achieved stage 1 after World War II. 11 aircraft carrier battle groups, more than the rest of the world combined. The U.S. Navy controls or projects power over every ocean. The U.S. military maintains bases near every critical trade choke point. The Strait of Hormuz, the Strait of Malacca, the Suez Canal, the Panama Canal, the Bab el-Mandeb. This isn't about defending American territory. This is about controlling the infrastructure of global commerce, making it structurally impossible for international trade to function without American approval. That's stage one. Military dominance over trade routes. The dollar achieved this in 1945. The dollar maintains it today. Stage one, complete. Stage two, massive trade surplus and wealth accumulation. Once you control the trade routes, wealth begins flowing toward you, not through conquest, through advantageous exchange. You're the middleman for global commerce, and middlemen extract value. Portugal in the 1500s ran enormous trade surpluses. They bought spices, silk, porcelain from Asia using gold and silver. But they sold European goods, textiles, weapons, metalwork at massive markups. Portuguese ships returned from Asia heavy with goods that sold in Europe for 10 times what was paid. This surplus transformed Lisbon into one of the wealthiest cities in Europe. Palaces, universities, churches covered in gold from Brazil. The wealth wasn't distributed. It concentrated in Lisbon. The Netherlands in the 1600s became the wealthiest nation in Europe through trade surplus. Amsterdam was the financial capital of the world. The Dutch controlled the Baltic grain trade, the spice trade, the slave trade, the luxury goods trade. Money flowed into Amsterdam from every corner of the globe. Dutch merchants accumulated capital at a rate that left other nations envious and resentful. Britain in the 1800s ran the largest trade surpluses in history. British goods, textiles from Manchester, steel from Sheffield, coal from Wales, were exported worldwide. Britain imported raw materials and exported finished products at enormous profit margins. The trade surplus built London into the financial capital of the world. British banks financed projects on every continent. British bondholders owned infrastructure in South America, railroads in India, mines in Africa. The sun never set on British capital. The United States achieved stage two in the decades after World War II. In 1950, the U.S. produced 50% of global GDP with 6% of global population. American manufactured goods dominated global markets. American exports exceeded imports by enormous margins. Dollars flowed out to pay for American goods, then flowed back to buy American investments. The trade surplus built American wealth to unprecedented levels. Stage two, complete. But here's where the pattern begins its turn. Here's where success creates the seeds of failure. Stage three, financialization and the shift from production to lending. When you're running massive trade surpluses, you accumulate more capital than you can productively invest domestically. You have excess money, and excess money seeks returns. So the reserve currency nation begins lending to other countries instead of producing goods for them. This is the pivot point. The shift from being a manufacturing power to being a financial power. From making things to financing things. Portugal hit stage three in the late 1500s. Instead of investing surplus wealth in domestic production, Portuguese capital flowed into lending to other European monarchs. The Portuguese crown financed wars, palaces, and expeditions for other nations. It was more profitable to lend money at interest than to invest in Portuguese industry. Portuguese manufacturing stagnated while Portuguese banks thrived. The Netherlands reached stage three in the early 1700s. Dutch capital stopped building Dutch industries and started financing everyone else's. Dutch bankers financed the British national debt. They financed Russian expansion. They financed the American Revolution. Amsterdam became a rentier economy. Wealth came from interest payments, not from producing goods. Dutch shipyards declined. Dutch textiles declined. But Dutch finance soared. Britain entered stage three in the late 1800s. By 1900, Britain was the world's largest creditor nation. British banks financed railroads in Argentina, mines in South Africa, infrastructure across the empire. It was more profitable to lend money abroad than to modernize British factories. British industry stagnated. Manufacturing moved to Germany and the United States. But British financial services grew. The City of London became more important than the factories of Manchester. The United States entered stage three in the 1970s and 1980s. American manufacturing began its long decline. Factories closed. Production moved offshore. But American finance exploded. Wall Street became the center of global capital. American banks, investment firms, hedge funds, private equity financed the world. It was more profitable to lend money than to make things. The trade surplus that defined Stage 2 began to reverse. And here's the key transition. In Stage 2, you export goods and import currency. Other nations need your currency to buy your products. In Stage 3, you export currency and import goods. Other nations borrow your currency and send you their products as payment. The flow reverses. And once it reverses, you can't go back. Stage 3, complete. The U.S. transitioned from industrial superpower to financial superpower between 1970 and 2000. And that transition unlocked Stage 4. Stage 4, massive trade deficits and debt accumulation. This is where the pattern accelerates. Once you're lending more than you're producing, your trade balance shifts from surplus to deficit. You're no longer exporting goods. You're exporting currency. And other nations are happy to send you goods in exchange for your currency because they need your currency for reserves. But here's the trap. The trade deficit means you're consuming more than you produce. You're living beyond your means. And to finance that consumption, you have to borrow. The reserve currency nation shifts from creditor to debtor. Portugal reached Stage 4 in the early 1600s. Trade deficits emerged. Portugal was importing more than it exported. The crown borrowed heavily from foreign banks, primarily Dutch and German bankers. Portuguese debt exploded. By the 1620s, Portugal was spending more on debt service than on its military or its colonies. The wealth that flowed in during Stage 2 was now flowing out to service debt. The Netherlands hit Stage 4 in the mid-1700s. Dutch trade deficits grew. The Dutch were consuming foreign goods, but no longer producing enough exports to balance the accounts. The government borrowed to finance deficits. Dutch national debt quadrupled between 1750 and 1780. Interest payments consumed a growing share of government revenue. The wealth was draining out. Britain entered Stage 4 in the early 1900s. By World War I, Britain was running persistent trade deficits. Britain was importing food, raw materials, manufactured goods from the United States and Germany. British exports couldn't keep pace. Britain financed deficits by borrowing, primarily from the United States. British debt to America exploded during World War I. By 1918, Britain owed the United States more than its entire annual GDP. The creditor had become the debtor. The United States entered Stage 4 in the 1980s and has remained there ever since. The U.S. has run a trade deficit every year since 1976, 49 consecutive years. The deficit isn't small. In 2024, the U.S. trade deficit was $1.2 trillion. The U.S. imports $1.2 trillion more in goods and services than it exports. How does the U.S. finance this? By borrowing. The U.S. national debt is $36 trillion. $36 trillion. That's 123% of GDP. The U.S. government borrows approximately $2 trillion per year just to fund operations. Interest payments on the debt are now over $1 trillion annually. That's more than the defense budget, more than Medicare. The United States is paying more to service debt than to fund the military that enforces Stage 1. Read that again. The military dominance that underpins the dollar's reserve status costs $850 billion per year. The interest on the debt costs $1.1 trillion per year. The debt is now larger than the military, and it's growing faster. Stage 4 complete. The United States is deep into Stage 4. The trade deficit is structural. The debt is exponential. And this creates the conditions for Stage 5. The application. History repeats itself. Stage 5. Currency debasement and loss of purchasing power. This is where we are. Right now. Stage 5. And this is where every reserve currency before us made the same fatal choice. When you're running massive deficits and accumulating massive debt, you have two options. Option 1. Cut spending, raise taxes, accept economic contraction, and pay down the debt. Option 2. Print money, debase the currency, and inflate away the debt. Every reserve currency in history has chosen Option 2, because Option 1 is political suicide. No government has ever voluntarily chosen austerity when they can print their way out. And so, they print. Portugal debased the real starting in the 1580s. The Portuguese crown reduced the silver content of coins to stretch the money supply. Merchants noticed immediately. Prices rose. The real bought less. Foreign merchants began refusing Portuguese currency or demanding more reals for the same goods. The debasement accelerated. By 1640, the real had lost 60% of its purchasing power. It was no longer trusted as a store of value. The Netherlands debased the guilder in the late 1700s. The Dutch government printed paper guilders to finance deficits. The money supply expanded faster than economic output. Inflation followed. Prices in Amsterdam doubled between 1780 and 1795. Foreign creditors began demanding repayment in gold or British pounds instead of guilders. The guilder was losing its role as a reliable currency. Britain debased the pound during and after World War I. The British government printed money to finance the war effort. The pound's gold backing was suspended. Money supply exploded. Inflation hit 25% in 1920. The pound lost half its purchasing power between 1914 and 1920. Foreign nations began questioning whether they should continue holding pound-denominated reserves. The pound was no longer synonymous with stability. The United States is in stage 5 right now. The Federal Reserve has printed trillions of dollars since 2008. Quantitative easing in 2008. Pandemic stimulus in 2020. Trillions of new dollars injected into the system. The M2 money supply, the measure of all dollars in circulation, increased by 40% between 2020 and 2022. 40% in 2 years. The consequences are visible. Inflation hit 9.1% in 2022, the highest in 40 years. Real wages adjusted for inflation, declined. The purchasing power of the dollar is eroding. What cost $1 in 2000 now costs $1.88. The dollar has lost 47% of its purchasing power in 25 years. But here's the critical point. This isn't a temporary problem. This is structural. The U.S. government cannot stop printing money because it cannot stop running deficits. The debt is too large. The interest payments are too high. The political will to cut spending doesn't exist. In 2024, the U.S. government collected $4.9 trillion in revenue. It spent $6.8 trillion. A deficit of $1.9 trillion. That deficit was financed by issuing new Treasury bonds. Bonds that the Federal Reserve often buys by creating new money. The Fed isn't buying as much as it did in 2020, but the mechanism is still there. When the government needs funding and private buyers aren't sufficient, the Fed steps in. That's money printing. And the debt compounds. Every year, the deficit adds to the debt. And every year, the interest on that debt grows. Interest payments are now the second largest line item in the federal budget. And as interest rates remain elevated, those payments will grow further. The Congressional Budget Office projects that by 2034, interest payments will exceed $1.6 trillion per year. That's 3.2% of GDP just on interest. Not infrastructure, not education, not defense, just interest. This creates a doom loop. The government borrows to finance deficits. The debt grows. Interest payments grow. The deficit grows larger. The government borrows more. And when borrowing becomes too expensive or difficult, the government prints. The currency debases. Inflation rises. And the cycle accelerates. Stage 5 is loss of purchasing power through currency debasement. The dollar is in stage 5. The debasement is happening. The inflation is visible. And foreign nations are beginning to notice. Stage 6. Loss of reserve currency status. Stage 6 is when other nations stop trusting your currency as a store of value and begin diversifying their reserves. They don't abandon your currency overnight. They slowly, quietly reduce their exposure. They hold less of your currency. They hold less of your bonds. They trade in alternative currencies. They build parallel systems. Portugal lost reserve status in the mid-1600s. Spanish silver reals began replacing Portuguese reals in international trade. Merchants in Asia and Africa preferred Spanish silver. Portugal's trade networks fragmented. By 1668, the real was no longer the currency of international commerce. It had been replaced. The Netherlands lost reserve status in the late 1700s. British pounds began displacing guilders in trade. The Bank of England became more trusted than Amsterdam banks. By 1780, international merchants were settling accounts in pounds, not guilders. The guilder remained a strong currency domestically, but it lost its international role. Britain lost reserve status between 1914 and 1944. The process took 30 years. During World War I, Britain borrowed heavily from the United States. The dollar began replacing the pound in international trade. By World War II, the pound was no longer the dominant reserve currency. At Bretton Woods in 1944, the dollar was formally crowned the new global reserve. The pound's reign was over. The United States is entering stage 6 right now, and the signs are unmistakable. China and Russia are conducting trade in yuan and rubles, bypassing the dollar entirely. In 2023, China and Brazil agreed to settle trade in their own currencies. China and France completed the first yuan-settled LNG transaction. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively discussing creating an alternative reserve currency or expanding use of local currencies. Central banks are diversifying reserves. In 2000, the dollar represented 71% of global foreign exchange reserves. By 2024, that number has fallen to 58%. That's a 13 percentage point decline. It sounds small, but in reserve currency terms, it's seismic. Central banks are quietly reducing dollar exposure. Gold purchases by central banks are at record highs. In 2022 and 2023, central banks bought more gold than in any year since 1950. China, Russia, Turkey, India are accumulating gold at unprecedented rates. Why? Because they don't trust the dollar's long-term stability. Gold is the hedge against dollar debasement. Saudi Arabia is discussing selling oil in yuan. For 50 years, oil has been priced exclusively in dollars. The petrodollar system has been a cornerstone of dollar demand. If Saudi Arabia begins accepting yuan for oil, the entire petrodollar architecture fractures. And that discussion is happening now. Digital currencies are emerging as alternatives. China's digital yuan is operational. It's being used in cross-border trade. The European Union is developing a digital euro. These aren't cryptocurrencies. These are state-backed digital currencies designed to facilitate trade without the dollar. This is stage 6, the slow, methodical process of other nations reducing their dependence on the dollar. It's not a sudden collapse. It's erosion, death by 1,000 cuts. And once it begins, it's nearly impossible to reverse. Because the loss of trust is psychological. Once nations believe your currency is in decline, they act to protect themselves, which accelerates the decline. Portugal couldn't reverse stage 6. The Netherlands couldn't reverse it. Britain couldn't reverse it. And the structural conditions suggest the United States won't reverse it either. Stage 7. Collapse and currency crisis. This is the endgame. The final stage, where decades of accumulated imbalances resolve in a short, violent repricing. Stage 7 isn't gradual. It's sudden. The currency doesn't slowly decline. It collapses, because at a certain point, the market loses confidence entirely. Foreign holders of your currency and bonds rush to exit. They sell. The currency plummets. Inflation spikes. Interest rates soar. The government can't borrow. It prints more money. Hyperinflation becomes possible. The economy contracts violently. Portugal experienced stage 7 in the 1640s. The real collapsed. Prices in Lisbon increased tenfold in a decade. The Portuguese economy contracted. Portugal lost its colonies in Asia to the Dutch. Spain reclaimed Portuguese territory. The Portuguese empire fragmented. The real survived as a domestic currency, but its role as a global reserve was finished. The Netherlands hit stage 7 during the Napoleonic Wars. The guilder collapsed in value. Dutch trade networks were destroyed. The VOC, once the most powerful company in the world, went bankrupt in 1799. The Dutch economy shrank by 30% between 1795 and 1815. Amsterdam lost its position as the financial capital of the world. The guilder endured domestically, but the age of Dutch dominance was over. Britain faced stage 7 after World War II. The pound collapsed. In 1949, Britain was forced to devalue the pound by 30% against the dollar. Devaluation triggered a crisis. Foreign holders of pounds dumped them. Britain's reserves evaporated. Britain required loans from the United States to stabilize the economy. In 1967, the pound was devalued again, this time by 14%. The currency was in freefall. By 1976, Britain required a bailout from the International Monetary Fund. The IMF imposed austerity conditions, spending cuts, tax increases, economic contraction. The pound survived, but Britain's status as a global power was finished. Each collapse followed the same pattern: decades of deficits and debt accumulation, currency debasement, loss of confidence, then a triggering event, a war, a financial crisis, a default, something that crystallizes the market's fear and causes a rush for the exits. For the United States, Stage 7 hasn't arrived yet, but the structural conditions are in place. The debt is unsustainable. The deficits are structural. The currency is being debased. Foreign nations are diversifying. The only question is the timing. What will be the triggering event? It could be a sovereign debt crisis, a moment when treasury auctions fail and the government can't find buyers for its bonds. It could be a geopolitical shock, a major war that requires massive spending and exposes the fragility of the debt structure. It could be a domestic crisis, a political breakdown, a banking collapse, a social fracture that causes capital flight. It could be a Federal Reserve policy error, a miscalculation that spikes inflation or crashes the economy. We don't know the trigger, but we know the structure is unstable. And we know from history that these structures don't resolve gradually. They resolve suddenly. When Stage 7 arrives for the dollar, the consequences will be global. Because the dollar isn't just America's currency. It's the foundation of the global financial system. 70% of international trade is denominated in dollars. 60% of central bank reserves are dollar-denominated. Trillions of dollars in debt, corporate debt, sovereign debt, is priced in dollars. If the dollar collapses, it doesn't just hurt the United States. It destabilizes the entire system. Emerging markets that borrowed in dollars face insolvency. Companies that operate in dollars face bankruptcy. Trade networks that depend on dollar liquidity freeze. The global economy contracts. This is the pattern. This is the 7-stage cycle. And this is where we are. Let me summarize what we've established. Stage 1, military dominance and trade route control. The dollar achieved this in 1945. Complete. Stage 2, massive trade surplus and wealth accumulation. The U.S. achieved this from 1945 to 1970. Complete. Stage 3, financialization and the shift from production to lending. The U.S. transitioned into this from 1970 to 2000. Complete. Stage 4, massive trade deficits and debt accumulation. The U.S. has been in Stage 4 since the 1980s. The deficit is $1.2 trillion annually. The debt is $36 trillion. Complete. Stage 5, currency debasement and loss of purchasing power. The U.S. is in Stage 5 right now. The money supply expanded 40% from 2020 to 2022. Inflation hit 9.1% in 2022. The dollar has lost 47% of its purchasing power since 2000. We are here. Stage 6, loss of reserve currency status. This is beginning. Dollar share of global reserves has fallen from 71% to 58%. China and Russia are trading in local currencies. Central banks are buying record amounts of gold. Saudi Arabia is discussing yuan-priced oil. The erosion has started. Stage 7, collapse and currency crisis. This is the future. The timing is uncertain. The outcome is not. For reserve currencies across 6 centuries, the Portuguese real, the Dutch guilder, the British pound, the French franc, each followed this exact pattern. Each believed they were exceptional. Each thought they could escape the cycle. None did. The pattern is not a theory. It's a historical record, a documented sequence that has played out 4 times with near-identical results. And the US dollar is following the same sequence, stage by stage, year by year. The question is not whether the dollar will collapse. History has answered that question. The question is when, and what you do with that knowledge. You can ignore the pattern. You can believe this time is different. You can trust that American exceptionalism will somehow override 6 centuries of historical precedent. That's a choice. Or you can accept what the data shows, that we are in Stage 5 of a 7-stage cycle, that the structural imbalances are unsustainable, that the erosion of confidence has begun, and that preparing for Stage 6 and Stage 7 is not paranoia. It's pattern recognition. The pattern is clear. The stages are defined. The evidence is undeniable. For those willing to look,